South Africa's leading pharmaceutical company, Adcock Ingram, reported a 31% increase in headline earnings per share to 465 cents per share. Turnover increased 8% to 4.5 billion rand. The pharmaceuticals division delivered a strong revenue performance with an increase of 408 million rand in turnover from the MNC partnerships. Final distribution to shareholders increased 4% to 106 cents per share.
Adcock Ingram got a market cap of 10.4 billion, a price earnings of 12.8, dividend yield 3.1. Tshepo, let's start with you. Not a bad set of numbers. What I immediately focus on, turnover up 8%, headline earnings up 31%, moving in the right direction. Perhaps we could say a little bit stingy on the dividend, but I think there's some issues there. We can touch on that in a bit. Fairly solid. Frankly, we expect that from our drug companies. They're supposed to be defensive. They're supposed to do all right in all times.
I think so. I think the numbers are the 31% increase is a little bit of an illusion given the BE transaction last year. So if you strip that out, it does speak to an okay set of numbers. I think overall, considering the year they've had in terms of one of their major products being taken offline in
DPP, which is what, about 5% of their. You're not going to say.
I'm not going to try say it.
About 5% of their revenue. That came late in the year, but that can certainly hit them down the line.
It can, and that coupled with an overridingly tough environment, it says that these sets of results are okay. I think considering all the challenges that they've had, I'd broadly say they're an okay set of results.
Anthony, they mentioned that they've been allocated a disappointing 4% of the antiretroviral tender. Take us through the history of such tender allocations. Obviously, from the sentence, one can infer that they are disappointed with that, and historically, perhaps the allocations were much higher. What is the extent of Adcock's dependence on these ARV tenders?
Well, the fact that they've managed to produce a credible set of numbers on only a 4% tender award implies that they're not that dependent. I think really what drives the business is some very mature products that are well known in the market in terms of branding, and a strong rand. You know, they really benefit hugely from a strong rand. But the business is not without its risks. We saw what happened with the DPP issue. We've seen what's happened with the lack of tender awards with the ARV. We've seen some other issues around production. We've seen, it is a company that is defensive, is probably fairly priced at this level, 13 times earnings. But it is, not a dripping roast.
Yeah, and you mentioned, yes, defensive, but the DPP, okay, that's appeal and everything else. Single exit pricing, no increases for 2011. They're not looking for any for 2012. That regulatory hurdles, and they are ARVs, as you mentioned, the regulatory hurdles really kind of add that element. Risk's a strong word, but certainly going to take some of that dripping off your roast every time. They might get one right, but something else potentially around the corner.
Absolutely. If they can't get price increases through, you could be rest assured that the logistics, transport costs are going to go up. Their selling costs are going to go up in terms of marketing. So there is potentially margin squeeze to come.
Tshepo, they have spent 290 million rand upgrading their manufacturing facilities, and I'd like to get your take on a pharmaceutical company essentially making investments in state-of-the-art plant and equipment. Number one, is 290 million rand, do you think it's a fair and justifiable amount, or could they have spent even more? And what about having to maintain and upgrade these facilities going forward?
I think I'll touch on expenditure as a whole, including the upgrade and their acquisitions within Africa. I think, look, considering the environment, you want a company that's spending their money wisely, and bulking up facilities is in my mind, a definite positive. And in terms of the acquisitions that they've made small strategic acquisitions that are starting to filter through in terms of revenue growth. So from that perspective, I think they're recognizing the challenges that the South African market is presenting, and they're looking to diversify away from just their local exposure.
You mentioned, certainly Africa. They're also looking at India. They've actually established a commercial office in India from June 2011. I'm hearing a lot of folks suddenly wanting to, 10 years ago was Australia. We've talked about this before. They're all coming home.
It probably is as hard as everywhere else, and I guess India, over and above Africa, you're competing not just with Indian companies, you're competing with the global players who are seeing India as this great economy that's growing so quickly. So I think it follows through with the general philosophy, which is go follow where the growth is, and we're seeing an increasing number of companies trying to follow growth in emerging markets as a whole.
Following growth and obviously expanding their footprint on the African continent too, Anthony, but let's talk on the decision to extend their MNC partnerships, which is the multinational corporations. What is the resilience of consumers in those economies? Because they're mentioning that consumer spending is concerning, obviously talking from a South African perspective, and the pharma players that they're going to be bumping heads with as they expand to the rest of Africa, the like of Aspen comes to mind. What's your take?
Yeah, I think that Africa, I think, is probably an easier market to operate in than India. India has, is the home of generic manufacturing. Cipla, Ranbaxy come to mind. So you would be competing in their own backyards. In terms of distribution to Africa, I think that's probably where the market's less competitive. I think that there's lots of potential increased consumer demand in these countries, and that, to me, would be a logical kind of growth strategy to play out.
So is it hot or not for you then, Anthony, or shall I give you a panado for the headache that Adcock is causing?
I'd say it's not hot.
Not hot for you. Tell us why.
Well, I just think that probably the defensiveness is in the price. We think that there are risks that potentially, are to come in terms of specifically around the regulatory pricing. Stronger rand could impact margins. I think that possibly Cipla and Aspen are better players into the sector.
Possibly Cipla and Aspen better plays for Anthony. Tshepo, how do you feel about Adcock, hot or not?
Not hot. I actually would broadly say the sector as a whole is a little rich for us. So we aren't playing in the sector right now. At a P of 13, I think it's about fairly priced, as Anthony touched on. So yeah, from my perspective, not hot.
Too not hot. Simon Brown, I know you take your vitamins every day. They've made a lot of acquisitions in the vitamins and mineral supplement sector. Surely you're going to give them a hot.
Yeah, I'm not convinced by the vitamins. I nice play. I worry about the DPP. I worry about single exit pricing. I would prefer Aspen in the sector, as Anthony says. For me, Adcock Ingram, not hot.
Not hot. Adcock Ingram. Specialist chemical services company Omnia reported diluted headline earnings per share of 346.1 cents for the 6 months ended September 2011 from 340.5 cents a year ago. Revenue from continuing operations was up 16% to 4.95 billion rand on the back of volume and international commodity price increases in the mining and agriculture divisions, but was partially offset by strong rand. Earnings per share increased by 2% to 346.8 cents per share.
Omnia Holdings market cap of 5.5 billion, price earnings 10.8, dividend yield 1.2. Anthony, a goodish set of numbers, considering they were frankly almost dead a year or two ago. They had to do R1 billion rights issue and stuff. Certainly moving in that right direction, bringing their dividend back after having cancelled it for 2 years. And the two things that are really firing for them, as we saw with Invicta, although they're in a slightly different space, mining and farming.
Absolutely. I think this one is quite interesting. We looked at it some time ago. We couldn't get our heads around the kind of seasonality in terms of the agricultural division and also kind of the input costs. So we found it quite difficult to forecast. But it really is in two sectors we particularly like. One is agricultural soft commodities, and the other is in explosives, which is kind of geared towards the mining sector. Earnings per share flat, but profit up 38%. They issued 37% more shares during the year. So I think all around a credible number. It looks very exciting as to what they're doing with this nitric acid plant. They're spending a lot of money. It hopefully will make their business less cyclical, less commoditized, and more predictable.
And that's due for Q1 of next year. So that will be, I suppose, not in the 6 months to March, but certainly in the year to 2012, we're going to see those numbers flowing through for at least half of it. Absolutely.
And in terms of the agrics business, it really will benefit from a weaker rand. Will they be able to price their fertilizer in dollars? I think also the agricultural kind of environment is very, very conducive at the moment. You've got very high maize prices. I think 3,000 rand per tonne is roughly the price at the moment, which is a record high. You've got the surplus being exported, so I think most farmers will be planting as much as they can in the coming season. You've also got moisture rates up at record levels. So we could have a bumper maize or grain crop this year. So I think they make the comment that they've already sold this season's kind of fertilizer at the old exchange rate, but next season it bodes very well for Omnia.
Tshepo, let's get your take on the debt-equity ratio of 35%. Don't you think that they should be taking advantage of this low interest rate environment? I know I take advantage of the low interest rate environment. And the idea would be to just really capitalize on raising debt and paying it off quicker because you want to take advantage of a low interest rate environment. But they're clearly going a different route, reducing their interest paid from 55 million to 36 million rand and raising that rights issue of 971 million rand last year.
The short answer is no. I don't want more debt. I think the rights issue was very important in terms of cleaning up that balance sheet to get it to that debt to equity level of 35%. So I think that worked tremendously well. So it's one of the few rights issues that we'd actually supported, and I think it's investors as a whole. The issue was oversubscribed, so the investment industry as a whole reaffirmed that it was the right deal for the company. In terms of actually issuing more debt, as I said, probably not, no.
Tshepo, I mentioned that the two legs which are really kicking on is mining, revenue up 25%, agricultural revenue was up 31%. The flip side of the third leg which is struggling is their chemicals, and that the space they're playing in there is the manufacturing sector. And I mean, as hard as I look, as much as I look, I can't see good news in that space right now.
No, that's true, and I think the set of numbers are reflective of that. Some may argue the strong rand may help in terms of alleviating.
Some would argue not.
I'd sit on the other side and say that it won't necessarily help the manufacturing sector. It may fire on other divisions, but not necessarily manufacturing. Yeah, I think it's a difficult space. We'll wait and see in terms of when that will recover.
Almost in a sense, I mean, can we almost say, what manufacturing's there, they make a bit of money out of it, almost right out of the equation.
Yeah.
When it comes back, it will. We might be a lot older, but it will. Then that's going to kind of almost be an extra kicker.
It will be. And in particular, the mining results are pleasing given the explosives in one of their production lines. I think it talks to very good risk management that the company has around that. And that's another potential kicker for the year ahead in terms of production from that particular segment.
Anthony, we're seeing the resumption of a dividend, the company paying 100 cents per share. Should investors be delighted with this payout? And just give us a bit of a history lesson in terms of the dividend payout policy of the company in prior years and whether this 100 cents per share is something that's going to be maintained going forward.
Well, I think the first answer is that investors are always delighted when they get a dividend.
Free money.
I think when the balance sheet was under stress, they probably withheld the dividend. I'm not certain about that. And I think that if the company continues to generate strong cash flows, as they indicate they will, I think that dividend could potentially be increased. So all around, I think a dividend is a strong indicator of strong cash flows and strong cash flow generating ability. In terms of the valuation, with this, there's a lot of kind of ingredients baked into the cake here. You've got to forecast a lot of things to get it right. And as a result, you'd want to get this thing at a kind of a discount to compensate for that forecast risk. It's currently trading at 12 times earnings, so the price is potentially quite full. But if you can get some certainty around the potential de-risking of the business or the decommoditization of the business, I think you can afford to pay a slight premium because it's in two very exciting sectors.
I want to touch on Africa. We always talk around Africa. Everyone's rushing off. Some guys, they're actually doing fairly well in Africa. They've got 21 countries. Is it also in part that what they're doing is easier into Africa? They're selling explosives, and the guys in the mines know what they want. You just transport it. They're selling fertilizers. The farmers know what they want. You just sort of transport it.
Yeah, I mean, 66% of the world's arable land lying fallow is in Africa. So there's huge upside in terms of potential increase in agricultural activity. Now, possibly the best way to play that idea in the South African context is to buy Omnia. If they can, capitalize on this opportunity as the world moves up the protein curve, you can see at the margin more and more land that's lying fallow come to account. And I think the best way to play that, or the least risky way to play that, is possibly through fertilizer stocks.
Well, gentlemen, the market certainly thought that Omnia was a hot stock today. It closed at 84 Rand, up 2.07%. Tshepo, I see you're grinning. Think you're going to go with a hot for Omnia?
Unfortunately not. I think one of the factors we like looking at is called the H score, which is a comparison of a company versus global peers and how efficient it operates. And Omnia, the high score you can get is 100. Omnia is sitting at close to 20. So in terms of its competition relative to global peers, I don't think the company as yet commands a premium to the market. So on that basis and on current valuations, I'd say it's lukewarm at best.
Lukewarm at best, a very low H score of 20. Anthony, how do you feel about Omnia, hot or not?
Well, I think on a historic valuation probably is quite expensive. But, you know, we would be inclined to do some more work on this and really trying to understand how quickly that high multiple will unwind given the potential growth in the stock. So I'm giving you a qualified hot because we haven't done much work on this, but it's something definitely that is now on our watch list.
Qualified hot from Anthony, definitely on his watch list. Simon Brown, hot or not, Omnia?
I so struggled with this one, and it's partly as Anthony said. I mean, you know, Samaze is great now, but where's it going to be? There's so many bits there that I need to bring into it to try and understand to make it all work. They're certainly coming out. They're in two great sectors, which is mining and agriculture. That 66% fallow arable land in Africa is an astounding figure, and certainly plays into it. I'm gonna say hot. I think there are probably more screamingly hot stocks out there. But I think Omnia has certainly come through looking good, stronger balance sheet. Let's give them a shot.